You may be wondering how mortgage rates are decided. Now, obviously, you want to make sure that you get the lowest rate possible, but how are mortgage rates determined, and what can you do to make sure that you have the lowest rate or you access the lowest rate? Hello, this is Ryan Wheeler with United Residential Mortgage, and in this video, I'm going to share with you how mortgage rates work. So there's several factors that affect how mortgage rates are determined today, but you can only control one aspect of the mortgage rate, and that's basically your own personal factors. So lenders look at qualifying factors to determine your risk level. So the better your qualifying factors, the better the interest rate that they're going to offer you. Mortgage rates are essentially determined by a type of bond called a mortgage-backed security, and they're affected by the overall economy. So when the economic outlook is good and the pace of inflation is higher, mortgage rates tend to increase because investors move money out of bonds and into stocks to outpace inflation, take advantage of economic growth. Our rates tend to fall when the economy is not doing so well because investors move that money back from the stocks back into the bonds to a safer asset like COVID-19 or the Great Recession. So the Federal Reserve doesn't set mortgage rates, but it can affect rates indirectly, and the Fed controls short-term interest rates to control the money supply and inflation and economic growth by decreasing them based on the state of the economy. So while mortgage rates aren't directly tied to the Fed funds rate, the Fed can change the rate and indirectly impact mortgage rates. So when the economy is struggling, like it has been during the COVID-19 situation, the Fed lowers the rates, and these rates don't impact consumers. It's what banks can borrow and lend to each other. So when the Fed decides they need to tighten up the money supply because inflation is too high, they raise that federal funds rate. And remember, inflation is bad for mortgage rates, so they can have an impact on mortgage rates. What personal factors can affect your mortgage rate? We certainly can't control the economic factors of mortgage rates, but you can most definitely control your own personal factors. So let's dive into what you can do to get the best mortgage rate possible, beginning with the obvious, your credit score. To lenders, a high credit score shows you pay your bills on time and don't overextend on credit. So when lenders pull your credit and see you as a responsible borrower, you're basically have a lower risk of default. So this leads lenders to give you a better interest rate because you're less of a risk. So when you have a low credit score, lenders often change the interest rate or give you a higher interest rate because you're a higher risk for default on the mortgage that you're trying to get. So a low credit score indicates that you may not pay your bills on time or that you've overextended yourself. So this is kind of obvious stuff. And taking steps to check and improve your credit will put you in a better position to get a lower rate from your lender. The next factor you can control is your down payment. And so the down payment, lenders want to know that you have money invested in the home. This is through a down payment, and generally the more money that you invest in the home for a down payment, the less likely you are to default and let the home foreclose, which also reduces your risk and could give you access to a much lower interest rate. So this kind of ties into the next factor that can impact your rate, which is called the loan to value ratio. And so the loan to value ratio basically compares the amount of loan that you're looking to borrow against the appraised value or the purchase price of the property that you want to buy. So the less money you put down on the home, the higher your LTV, loan to value, which can become a higher risk to a lender. And so lenders can charge higher interest rates when there's a higher risk. So which means if you put down more money, you'll have more money to lose. Another factor is how you intend to occupy the property. So occupancy, lenders care about whether your home is your primary residence, which means will you be living there, if the home is a second home like a vacation home. And finally, if the home is an investment property, one that you rent out to others. Interest rates are always going to be the lowest on primary residences because you are much more likely to let a second home or an investment property default before your own primary residence because it's where you live. So it's going to impact the risk and your interest rate. So bottom line, folks, is that both market and personal factors affect your mortgage rate. And while you can't do anything about the market conditions, you can control your personal factors. Improving your credit score and saving for a larger down payment are two of the best ways you can improve your chances of securing the best mortgage rates. So thanks for watching. This is Ryan Wheeler with United Residential Mortgage. And if you know somebody that is looking to buy a home or refinance or just get some questions answered, please call me or text me at 270-228-0075 or go to unitedresidential.net and schedule a call with me. Look forward to helping you soon. Take care. Have a great day.